Hey miners, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are joined by Patrick Fleury. He's the CFO of TeraWulf, and a very topical discussion today as we're seeing some concerns about the new Chinese AI HPC entrant DeepSeek and the impact this may have on the North American Bitcoin miners, specifically the ones with HPC AI exposure. That's what we're going to be talking about in today's interview. Before we get into it, take a second, hit the like button, you guys. Big help to myself and the channel. Anthony loves it. If you're not already subscribed, McNallie Money, feel free to join. And let us know in the comment section below if you're currently holding shares of TeraWulf, how you're feeling about today's news, and your outlook for the remainder of 2025. Now, with that being said, let's get into today's video. Okay, guys, so that's right. Monday morning, we've got the CFO of TeraWulf, Patrick Fleury, back on the program. A very timely interview indeed in light of this weekend's events. We're going to come on to that in a second, but Patrick, welcome back to the channel. Great to see you and Happy New Year.
Likewise. Thanks, guys. Thanks for having me.
Most definitely. So we'll get right into it. I'm sure you've got 1,000,001 things going on, Patrick, today. Since our last visit, November 15th, there's obviously been a number of big updates on the macro environment and from TeraWulf specifically. So can you share with us just some of these key developments over the past month and a half?
Yeah, sure. Look, we've been really busy, as you know, in our announcement on December 23rd of last year, which I know a lot of people are on vacation already. You know, we weren't, but that was really the culmination of a year's worth of working with various customers to get to the finish line with, one customer. And we couldn't be happier with that customer, Core 42 and G42 and, a number of the entities that they interact with on a daily basis have been in the news virtually every single day, right, since we announced that transaction, and particularly since Trump, has taken office and announced a series of initiatives with regard to AI. But yeah, Core 42, G42, like I said, we couldn't be happier with that customer. I think they're the perfect anchor tenant for us. Just to give you a sense of the process there, I think they visited over 60 potential sites in the US and picked us. That's obviously a lot of different management teams as well. And the focus, I think, from both sides was on not just who has the deepest pocketbooks, which that obviously matters to me because I have to go debt finance our build out, right? Which is the one sort of big difference if you look at the only two folks that have announced these deals, right? It's Core Scientific and TeraWulf. Core Scientific, to their credit, right, has an amazing deal where they got CoreWeave to pay for everything. I don't think you'll see another one of those deals, period. So what we have, I think, is the next best thing, but candidly with some better terms, which is, we've got a 10-year lease with Core 42. It is supported by a parent guarantee from G42. G42 is effectively, part of the UAE sovereign. They are backed by Mubadala, which is the sovereign wealth fund, over 250 billion of assets. They have a $1.5 billion investment from Microsoft. Microsoft's president, Brad Smith, sits on their board. They have an investment from Silver Lake and the Dalio family office. If you look at G42's board, it is one of the most impressive boards in the world. So again, from a customer quality perspective, having that sort of parent corporate guarantee for us on a 10-year lease, and that lease has 2 5-year extension options, so it potentially could be a 20-year lease. And again, the way we structured it economically is when Core 42 executes a lease, which they did for our first 72.5 megawatts, they provide a 1-year revenue prepay. So on that 72.5, that is gross megawatts. When you factor in a 1.2 PUE, we are down to 60 net critical. So on that 60, we are earning 1.5 million of revenue per megawatt. That escalates at 3% annually. And we think, and I know this is conservative because I've been asked about this many times. We think that's roughly a 70% EBITDA margin. That's kind of what we're guiding to. I know Core Scientific is guiding to 80. There are two levels of conservatism in that number. So I just want to point out the difference. One, to their credit, Core Scientific has actually operated a sizable building with CoreWeave for quite some time. We have not. So I want a level of conservatism in there until I have some experience operating, and then I may or may not change the guidance. So that's number one. Number two, and I think you'll see us flesh this out when we file our 10K at the end of February and update our investor deck, is I say 70% EBITDA margin. It's really, that number is really actually free cash available for debt service. And what I mean by that is maintenance CapEx of, call it 3 to 5% of revenue, is in that 70% number. So it's really kind of like a 75% EBITDA margin versus core at 80%. So again, the reason I focus on that is the number one takeaway for me in all of these deals is yield, right? And I'm going to sit for a moment. I've seen other people, other companies talk about revenue. That would be like talking about Bitcoin and not talking about network hash rate. You literally can't talk about one without the other. So revenue, right, only matters if you know, that's the numerator, what the denominator is, which is what is your CapEx to build it out. So again, the way that I look at ours is 1.5 million of revenue, 3% annual escalator, 70% EBITDA margin. That's just over 1 million of EBITDA per megawatt. And that's on a net critical build cost of approximately 6 million per megawatt. So that is a high teens yield. And I think as we look to expand our site with this customer or with other customers, that is all that matters to me. And what I mean by that is if a customer wants me to build them a 10 or 12 million per megawatt data center because of either the AMD or NVIDIA chips they're using or whatever they want in there from a redundancy perspective, I will do that, but I'm going to solve to get to that same yield so their revenue will be much higher. And I think one of the things Core 42, I think, recognized about our site, as you guys know, which we've been talking about for quite some time, is it's a very atypical site because it's at a retired coal plant. So like, for example, we have two 345 kV lines coming into our substation and switchyard. That is the highest voltage transmission line in New York State. So we are literally tied into the critical backbone of New York State. There's only one time in the last 45 years where our site went dark, and that's when the entire Northeast grid blacked out in 2003. And so that is a huge advantage, right? Because you have a site that was built by a local utility in the 1980s, and they basically gold-plated everything because they put it in rate base. So we have redundant transformers. We have redundant tie-ins to that 345 kV line, which means we don't have to do things like add backup diesel generators in the event we lose a line into the transmission system. That's a big cost. That's literally like somewhere between, depending on which vendor you talk to, 1.5 to 3 million per megawatt in additional cost for something that is frankly 18 to probably 24 months out, getting it from like Cat or Cummins or any of those folks, and you have to permit it, and it's not ESG friendly, and it's really running like 10 hours a year when you test it, right? That's not, if you lose power, those diesel generators are not running your LLM model. They're just cooling down the rack so you don't melt the rack, right? Because you've got 120 per kilowatt power density rack. So again, those are the types of things that, because of the uniqueness of our site, I think our customer recognized, and that means like they have to pay more, right, to get the same kind, or excuse me, they have to pay less to us to get the same kind of redundancy that they might get somewhere else because of our site. So I think broadly speaking, and I'll pause there because I know that's a long tirade on our economics, but they're just critically the 1 year revenue prepay, okay, is the key for me because that's roughly 30% of my build cost. So that's effectively my equity, which that then allows me to go on the back of a 10-year to 20-year lease, get project debt financing, which I'm working on right now, right, for the other 70%. So the massive take home point there, and I know I've been harping on this with you guys for a long time, is it requires no equity from TeraWulf. And remember, I equity funded by issuing my convert last October, the first 72.5 megawatts. So that is fully funded on an equity basis, which means when I get this debt financing in place, I can take out, because that first 72.5 megawatts is going to cost 350 to 400 million bucks. So 70% of that, right, is 250 to 300 million bucks that I can get back. And I can tell you, if that was sitting on my balance sheet today, there would only be one thing I'd be doing today. I would have canceled the podcast with you guys and I'd be buying back as much stock as humanly possible today. So I think, again, when I look at like what we're doing versus a lot of our peers, certainly in Bitcoin mining and in high power compute, I am in the mode of trying to buy in stock now. I don't want to issue any more stock, period. And if I can do that and keep this flywheel going on the next 500 megawatts of high power compute and AI, that's what I'm going to do.
Yeah, you raised some good points there, Patrick, and great that you give credit to Core Scientific, who have quite rightly been dealing with this type of contract with CoreWeave throughout this year already, and they've been partnering with CoreWeave for years and years in their Ethereum mining days. So they've done this type of thing before. They're not new to the market. In terms of Core 42. Do you have an understanding of what they're going to be doing? I mean, they're obviously a UAE-based organization coming into the States and setting up. Is this for them to break into the market here, or are they already currently operating in other areas? And maybe lead on to do you have a sense of their plan? I mean, we were fortunate to be at the Core Scientific Investor Day when they announced the first 200 megawatts. That's now 500. What do you see from your perspective with this arrangement with Core 42? Do you see potential growth with this client as well?
Yeah, great question, Anthony. So Core 42 and G42, right, been around for quite some time. They already have 2 data centers operating in the US today. They have data centers in France and the UAE as well. So they've been doing this for quite some time. And they're not, we are helping them expand significantly in the US, but they're already here, already doing it. They've got a data center in Minnesota. They've got one in Texas. So this is not their first rodeo. They are very similar to, they have the same model as CoreWeave. Okay, which is aggregating large enterprise customers. The only difference, right, is they've got large enterprise customers in the UAE, including the sovereign, but then they're also aggregating Fortune 500 companies here in the US. And similar to CoreWeave, they have Microsoft sitting on their board, who's made $1.5 billion investment in the company, right? So it's I think what you're starting to see is even with CoreWeave's model, where you have a hyperscaler behind their formation, similar situation here, where Core 42 is our tenant, and we will likely grow with them significantly at our site. They're in many respects an aggregator of capacity, and they'll aggregate hyperscalers, they'll aggregate large enterprise customers, right? And it's UAE based and domestic, but I think the key for us, because there were a lot of questions when we first announced this customer, they could not be a better customer. I mean, G42 is one of the few entities in the world that is approved to actually import from the US government to bring NVIDIA chips into the UAE. That list is extremely short. And I think after this weekend with DeepSeek, like that list is going to get even shorter very quickly.
Also,
Right. So
quick.
I know, like if you Google, for example, 442G42, you may see historical ties to China, right? Those were jettisoned to permit Microsoft to invest in the company and sit on their board. So really, like when I look at it, and again, we started, as you know, with about 24, 25 different clients as potential customers at this site. But hyperscalers, as you know, they don't want TeraWulf or Bitcoin mining peers building their data centers because they have teams of hundreds of people that do that. So they're willing to give you a sort of powered shell yield on cost. For me, for 250 megawatts, that creates like $1 billion of value. Versus, in my opinion, doing the customer deal I just did with that type of customer, that creates like 5 billion of value for the same megawatts, right? So I think time and time again, when I look at like our customer quality and the economics we received on this deal, if I can continue to just repeat that, I will continue to do that. And I think um, despite the DeepSeek, announcement today, and I think the overreaction in the stock market, we're talking about it might not be a 50-year cycle like semiconductors were, just because capital markets are so much more efficient now. But I think this will be a 20, 30, 40-year, industrial revolution for our generation. I mean, AI is going to be pervasive in everything we do. So I don't think this latest news will limit growth, as in any nascent industry. You have to have leaps and bounds forward in efficiency, and that will lead to, I learned this morning, so I'm not going to take it. Jevons paradox, created by an economist, right? The idea is, right, with greater efficiency and lower price point, that leads to massive increase in adoption. I think that's exactly kind of what we're seeing happen real time, right? And now, as we all get older, like the capital markets just move so much faster now in capital formation, and to see how DeepSeek kind of changed their whole process versus what we're seeing from others, like it's just a massive learning opportunity. But I do believe that the power demand, right? If you think about like where we are approaching this, I'm not buying GPUs, right? As you guys know, I don't want to compete with my customers. And not only that, I don't have the capital cost, right? Or weighted average cost capital that my customers have. So all I want to do is provide what we are really good at, which is energy and power infrastructure, and let my customer figure out what, they want to tackle and own the GPUs.
Just on that energy question there, I'm assuming energy is provided by Beowulf, though, is it on this contract, or is it provided through TeraWulf?
No, it's provided through TeraWulf, right? So TeraWulf leases the land and has the right to 750 megawatts of power at the site, right? So today we're mining 200 megawatts of Bitcoin mining today. And we're targeted to increase that this quarter to 250. And then we'll have the 72.5 megawatts of high power compute coming online this year. So 2.5 of that, the Wulf Den, will be this quarter. The first building, which we call CB1, that's co-location building 1, 20 megawatts, that will be second quarter. And then CB2, which is 50 megawatts and broken into 2 data halls. So we call it CB2A, CB2B, each about 25 megawatts. That'll be third quarter and fourth quarter for online. So that's when I expect the revenue to actually start kind of running through the income statement.
Makes sense. Hey, just one follow-up. You obviously made reference to DeepSeek. Since our last discussion, we also have seen Trump's inauguration. He's come in very heavy with this StarGate initiative, making America the crypto and Bitcoin capital of the world alongside HPC AI. So I was just curious, Patrick, given this advancement with DeepSeek today, or this news, do you think that will motivate Trump even more to bring these resources within the United States and push the United States development harder?
I do. I mean, I do. I think this is kind of a Sputnik moment for our generation. right? And I know certainly what I like about high power compute and Bitcoin, right, is the focus is to have it available to the masses, right? There is a like democratization of it, that's kind of pervasive in both industries, which is really nice to see. But the reality is it's an arms race, right? Because if you believe AI is going to be as pervasive as I think it will be, every sovereign will need to have it, right? And as these computers and even quantum computing and AI get more sophisticated, more cybersecurity concerns, right? So I do think there will be a sovereign arms race, and in addition, a desire to onshore everything, which if you think about, that's what we are doing, right? We're using domestically made chips. All the money's coming here to the US, right? We're consuming largely zero carbon excess power at our site, right? So yeah, I think particularly with Trump's focus, you're going to see massive dollars and re-onshoring of all of this technology, and I think a limitation, even more stringent limitation on the exportation of chips and that knowledge and know-how and technology to other sovereigns.
In terms of, I mean, you talked about the CB1, CB2 going through to the end of the year, so you have that 72.5 megawatts all up and running. In terms of expansion on top of that, I think in your previous presentation, you look at, I think it was 178 megawatts potentially in the second half of the year. How much of that would be funded with current funds, or is it a case of we'd have to raise money if we signed up further clients in this sort of like 2025 we sit at the moment?
Yeah, so I think that's right, Anthony. We've kind of said we have another 250, right, of capacity total to bring online kind of by first half 26. I think in our last presentation, it kind of showed our ability to do that by the end of 25. And I think as we've kind of moved forward in time, that's kind of pushed out a little bit. But I think, yeah, first half 26. Yeah, I think that's there. And as you know, this is one customer, and we danced with a lot of customers. So there is a lot more demand behind this customer. This customer has an option on 135 additional megawatts. That option expires by March 31st. So I think that's obviously a very short time frame. It's also a very specific number, right? Because we've been in discussions with this customer for quite some time, and we've had teams. I mean, I don't want to underestimate. I don't want people to underestimate how hard this is, right? There's a reason why Core Scientific and us are the only two that have announced deals, because the level of coordination between us, the customer, NVIDIA, AMD, Dell, T5, like all the folks that we have in this is incredibly high. And not only that, but you're not building like serial number 1,000. I mean, literally in the world today, I can count on two hands the number of 10, 20, 30 megawatt GPU clusters running today. So to build a water-cooled, right, 120 kilowatt per rack power density data center, like it's not like a cookie cutter process. It's not like building a natural gas plant because there's been thousands of them built, right? So it is difficult. And the financial engineering, like in my seat, that's the easy part, right? The meat and potatoes, blocking and tackling of actually like designing and getting this stuff on the ground is a challenge. And so, yeah, I think we can deliver. We've gotten comfortable internally that we can deliver kind of 100 to 150 megawatts a year going forward. When you think about, I've got another, call it, and just assuming I'm going to keep running my Bitcoin mining operation, let's say till the next halving. So that's 250 megawatts. And then I've got about 500 megawatts of running room, greenfield to kind of build out before I would have to go and cannibalize Bitcoin mining, right? And so that's kind of where we are. And I think, the Bitcoin mining operation is great. I think we'll throw off 75 to 150 million of free cash flow for the next, annually for the next couple of years, depending on network hash rate and Bitcoin price. But I think, Anthony, the key again to growing our high power compute business is if I can go get those same terms that I've announced with this customer, that requires either zero or very, very little equity from TeraWulf, which honestly, it's not equity. It would just be free cash flow from the mining business. So instead of buying back stock with all that free cash flow, I put a little bit of cash into the high power compute build out to kind of, fund a very small sliver of quote equity. Because again, my 1-year customer prepay is effectively my equity.
In terms of one final question on HPC before we go on to the mining side, in terms of the Den, which is the 2.5 megawatt project, how important was that running in your discussions with Core 42 and other potential clients? Because you've already highlighted yourself, you weren't in the space like your peer miner that you've already disclosed. How important was that to show that you could actually deliver these types of projects?
Very, 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 can't even underestimate how important, right? Just because again, I mean, this is it's not easy to do. And even building that, learning from everyone as we're building it, having customers come to the site, not just this customer, but others, and say, hey, we like what you did here, but we don't like what you did there, and we might change this. And just, I mean, simple stuff like, as you guys know, I mean, Bitcoin mining buildings are very crude. I mean, it's effectively the same electrical type of, right? You got to electrify a 50 megawatt building. Electrical infrastructure wise, same, really, like you're getting the electricity to the building. Once you're at the building, 100% different, right? I mean, Bitcoin mining is all about clearing hot air and ventilation and getting airflow through there to make sure the miners are as efficient as possible. I mean, what we learned with the Wulf Den, right, was, and I forget even the technical term. I know Nazar and my operations team, but things like, you walk in and there's like effectively like a vacuum door that takes all the dust and either sticks it to the bottom or sticks it to the top. So there, you walk in, there's no dust in the building, right? I mean, that couldn't be more different than a Bitcoin mining building. So things like that again, we're not proclaiming to be experts in that building, which is why we've got an army of people helping us. And we are now becoming a lot more knowledgeable, having studied it for a year. But, what we are experts in is getting the electricity to that building, right? And then we've obviously augmented our team with tons of folks, both internally and externally, to figure out that design. But yes, I would say the Wulf Den was absolutely instrumental and necessary to get over that hump of being able to sign an agreement with a customer.
Yeah, great question, Anthony. And we've heard those pilot models are pretty integral to most of these companies. So nice to see that actually worked as intended. Now, Anthony mentioned we'll jump over the Bitcoin mining side here, Patrick. We noticed last month the cost of electricity per Bitcoin was up about 52%. This was somewhat expected due to the sale of your Nautilus facility. Obviously, that was the lower power rate of the two facilities. Can you talk to us a little bit about that seasonality? What component was Nautilus? And can we expect this to be the new norm in terms of energy cost per Bitcoin?
Yeah, geez, I hope not. But there is, as you said, there's a reasonable explanation for that. As you know, Nautilus was fixed 2-cent power, which was a true unicorn, right? Not only behind the meter at a nuke, but 2-cent power, right? Fixed all the time. And that was, credit to Nazar and Paul and Kerry and the team for, I mean, that was a truly amazing contract. Lake Mariner is an incredible location because, as you know, there's 8,760 hours in a year. The vast majority of those hours at Lake Mariner, there's just not much demand. And what I mean by that is we sit in a zone in Northwest, New York, where there's about 5,000 megawatts of generation and on average about 1,800 megawatts of demand. And not only that, but the 345 kV system, which is what moves electricity in New York, literally starts at Niagara Falls in the west, runs west to east. We are 30 miles east of Niagara Falls, and the first bus bar coming out of there, as all that power makes its way across from west to east across New York State, hits another 345 kV line that comes down from Quebec down basically the Hudson River, and all that power tries to make its way to Westchester, New York, the load pocket there. Unless you have very cold weather or very hot weather, you typically do not have high power prices. So unfortunately for us, right, we just sold Nautilus, as you pointed out, and then we had effectively what is a 1 in 5 to 1 in 10 year event, basically come through both in December and January and affect our site. Now, I think what you'll see is power prices were extremely elevated in December, and vis-a-vis our peers, some of our peers, like particularly in Texas, didn't have that. But as you guys know, I'm transparent, and that can be good and it can be bad. So you're going to see what our results actually are. I'm not going to try to hide it. But yes, we had really high prices in December. Unfortunately, that's been followed by really high prices in January too, because most of the country has been in a polar vortex. I think the difference is that's now impacted a lot of my peers also in Texas, right? So I think January for the miners in general, it's going to be pretty darn ugly, because you've also had network hash rate kind of going through the roof, right? So so again, the beauty about Lake Mariner though is having been involved in that site for almost 10 years, these types of blips happen, but then mostly for the next like 7 to 9 years, right? It's very kind of calm, and on average, again, we think like probably around 4 cents there. I mean, last year, as you guys know, we averaged 3.8. This year, in 23, we averaged 3.8 cents there. In 24, I think it'll be a little bit higher than that. But the odd thing too for us, which again, a little different than our peers, is we do participate in 3 different demand response programs in New York, but those programs tend to really only matter in the summer months. So we don't really get demand response revenue in the winter. It does happen, but it's very rare. So it's more economic curtailment on our behalf, right? Which is like a double negative. You're not running and you're not getting any payment, right? So it's been December was tough, and I think January will be tough for the whole space. But I do expect that's not going to be the norm, particularly when you look historically at Lake Mariner and for the future. Unlike other regions, what I love about New York, it's not like Texas. New York is very difficult to cite additional demand, like to get permits to actually increase demand precipitously in New York is very hard. So that creates a bit of a moat around my business, which I really like. And I know a lot of other people say, oh, New York's so hard to do business. Yeah, I hear you, but you didn't retire the last 2 coal plants in New York, and we did. And that, I think, garnered a lot of political favor and has us, and not only that, but we also are, the biggest taxpayer in the Lake Mariner region, which largely goes to schools. We've also rehired the vast majority of all the power plant employees that have been there since the 80s. So I think there's a lot of like really positive things that we're bringing to that region.
That's cool. With the Bitcoin price, I mean, I think end of Q3 was 63,000, end of December, 93,000. It's over 100,000 today, although it's been a bit volatile today. But with that sort of like 100,000 breaching, for numerous periods now since the inauguration, has your thought process changed with regards to the mining side? I mean, in the previous podcasts, you were adamant about we're going to just grow to what we grow effectively, I think, by the end of Q1 2025, and then the focus then really is on HPC. I had this question planned obviously before the news today, with all what's happened today, but I'm assuming that does that change your view at all? If the Bitcoin price does continue to rally through this year, you don't see the mining side growing more than I think it's sort of just over 13 exahash at the end of Q1.
No, not at all. And look, I think there's a couple of factors there, right? Bitcoin is an extremely volatile commodity, right? So, and again, you can't talk about Bitcoin credibly, in my opinion, if you don't talk about network hash rate, particularly if you're in the mining business. So many of my peers, public peers on the Bitcoin mining side, I have seen in what I would characterize just bluntly as a race to the bottom. You have multiple companies diluting shareholders every single day to get to 30, 40, 50 exahash. And for what reason? Because as network hash rate climbs and climbs and climbs, I mean, I don't know if you guys saw, we actually hit 900 for a brief moment. That means your margins shrink and shrink and shrink, particularly if Bitcoin price is not increasing parabolically. So right here and right now, even though Bitcoin is at 100,000, I would, if you look at network hash rate and actually calculate people's margins, they're making a lot less money than they were when Bitcoin was at 60,000 pre-halving, right? And network hash rate was at 500. So to me, like the single worst thing about Bitcoin mining is you're just going to have the OEMs continue to produce machines nonstop. And now you're going to have more competition in that space from folks like Auradine and Canaan and others. And the reality is, given where they can produce those, if they don't sell them to public Bitcoin miners, they'll just take them and go plug them in, because then their return on investment on that is like, you know, somewhere between 9 months and 18 months, depending on what your power price is. So that is unfortunately the toughest part of Bitcoin mining. It's not just where Bitcoin price is, right? It is where is network hash rate in relation to Bitcoin price. And so I think I've honestly been shocked at how long the capital markets have been willing to finance many of our peers, because as I've told you before, stacking Bitcoin on your balance sheet at the expense of diluting shareholders to pay for all costs in your business, including paying your management team like they're the starting lineup for the New York Knicks, that is not a business model. I don't ever want to be a part of it. And I think that'll be on the wrong side of history, in my opinion, in the future. Particularly when you can go buy an ETF for 5 to 10 basis points and you're never going to be diluted, right? So Bitcoin mining is a tough business. You got to have really good power, and you got to have increasing, as we know, with Moore's law, with ASICs increasing in efficiency every year. I mean, it is just a massive capital cycle after a massive capital cycle after a massive capital cycle. And like everyone's following everyone down, you know, the same sort of grow at all cost rabbit hole. And we don't ascribe to that. I think in any commodity business I've ever invested in over 25 years, there has to come a point where there's capital return to shareholders. You can't just keep diluting people into oblivion. And so
it sounds like you sounded like an analyst that I mean, we were fortunate to meet a bus full of these analysts at Corsicana and Denton middle last year, and we asked the questions about Bitcoin mining, and I guarantee you, all those analysts and they support you and all the other peer miners. They said at that point in time, Bitcoin mining isn't an industry.
Yeah, look, I don't. But Anthony, I don't.
Not one that they can sort of like, you know, in terms of, you know, the ideology. And even in November, I was on a plane with 3 analysts, and I said to them, I said, tell me, you know, what sort of what you think, you know, the Bitcoin mining, etc. at the moment. And he said, I got my analyst to run the numbers, and it just doesn't stack up. And you're now effectively sort of like, coming out and sort of partly agreeing with what they're doing, what they've been saying for, the best part of 2024.
Yeah, and look, I would just say, as an former institutional investor, right, I just have a different perspective of Bitcoin miners. To me, should trade like refineries. You're a price taker. Refineries tend to kind of trade like 6 to 12 times EBITDA, peak to trough, right? And so I look at our business, and again, I told you, I think our business at 13 exahash generates 75 to 150 million of free cash flow. So I think we're probably closer to trough pricing today. So that's probably a 10 times business on, let's say, 100 million of cash. So that's $1 billion of value, right? And I've got 400 million shares outstanding. So that's 250 a share for the Bitcoin mining business. High power compute and is a very stable 10 plus year lease business, right? That increases 3% every year and has amazing counterparties. So no variability, which is why you look at companies like Equinix or Digital Realty, who are now REITs, which I can do ultimately, they trade at 25 times EBITDA. So again, if I can get a very stable counterparty, stable business that trades at 15 times EBITDA versus being in a business that I think maybe max should be like 6 to 12, and all I'm doing is just using megawatts for high power compute instead of using like, to me, there's zero competition there. It just doesn't, like, I will do high power compute all day every day, and ultimately I have right now 300 to 400 million of NOL and tax deferred asset. So what my plan is over the next 3 years, run the Bitcoin mining business for free cash flow, eat up all that NOL and deferred tax asset, build out high power compute by at least 500 megawatts. At that point in time, likely convert to a REIT, because when you convert to a REIT, you have to have a retained earnings purge. And if you have positive retained earnings, you have a tax bill. So I'm going to try to get it so I have literally zero retained earnings. So I've chewed up all my NOL. So I'm not a taxpayer for the next 3+ years. Convert to a REIT, and then if I can trade at 25 times EBITDA and I have 500 megawatts, by the way, 500 megawatts is roughly 500 million of EBITDA. If that trades at 20 times, that's $10 billion of value. And it probably takes me a couple billion of debt to get there. So let's say 8 billion of value on 400 million shares, that's $20 a share of value. Right. So
yeah, those are the numbers that came out from a couple of the analysts that I spoke to, and 15 on the very prudent side, 15 to 20, and like you're saying, you're seeing some tech companies at 25, but they said for the mining side of it, probably 5 or less was their view, and so can sort of like can see that. I mean, you raise a great point about the global hash rate. I mean, I checked today, the 7-day moving average was about 770. So we saw these spikes all the way through 2024. It reached 800 many times in 2024, but actually it was literally for a day and half, for hours, and it was coming back down. I mean, it is a race. It is going up. I don't know where the hash rate is going to be by the end of the day. I gave a quote that it would probably be about just over 1,000 in terms of at the end of 2025. But I suppose it really depends on, if you can source cheaper energy, then it means that you've got a better opportunity to drive revenues from maybe not the most efficient machines on the market. You can plug in some lesser efficient machines and get a return if your energy is really, really cheap. And we're seeing some numbers coming out now from certain areas in the market where they're sort of trying to track into some of this stranded power at really low rates. But no, that's interesting. On building 5, as we just quickly finished the Bitcoin mining, I believe, again, it's from your update, I think it's about 3.4 exahash of S21s are going to go in there when it's completed. Just give us an update of where we are on that building, when we expect to be energized, and that gets you then to your, I think, 13.4 exahash in mining.
Yeah. So S21s have been arriving at the site in January. So building 5, is, I would say, a little bit behind schedule, only because, again, we have had, I don't know if
Yeah.
you've been paying attention to Buffalo.
Oh, we
I
have.
watching the games, but a lot of snow, really cold weather. So that's kind of set us back a little bit just from, again, meat and potatoes of putting up, you can't hang steel beams when it's, blowing 25 miles an hour and snowing. But still on pace for first quarter deployment. And yeah, I mean, really happy the teams have been battling some pretty adverse weather conditions up there this month and in December too. But on schedule for first quarter should be at that 13, little over 13 exahash.
In Scotland over here, they've had some adverse weather conditions, so much so that some of the residents are having to wear t-shirts now to keep the cold away. So little little news update from the United Kingdom.
There you go. We won't touch the NFL playoff topic today, Patrick, but I have been watching and I saw a snowstorm in Florida here, so all kinds of weird weather. But obviously a big day for yourself, Patrick, as CFO. A million things going on. We want to be respectful of your time, so I'll give you an opportunity to close out. Great to hear from you, and congratulations on the big announcements in recent weeks here.
Thanks a lot. Yeah, look, we're really excited. I think 2025, a lot of news coming down the pike here, right, in very short order. Got our customers option. We've got big debt financing that frankly should provide a lot of opportunity to benefit shareholders as well, freeing up a bunch of that equity capital. And then I think you'll continue to see our path to additional growth in high power compute with both this customer and additional customers. And then really just running that Bitcoin mining operation as efficiently as possible to squeeze out as much cash flow as possible. So yeah, very excited for the year. It's going to be a busy one, just like last year. But appreciate you guys having me on and the opportunity to speak to your listeners.
Of course. Well, very timely interview today with TeraWulf, Patrick Fleury, CFO. Let us know in the comment section below. Are you currently holding shares of Wulf? How do you feel about the outlook of the HPC AI sector in the US given today's news? And of course, your thoughts as we head into 2025. We'll be back here tomorrow. Thanks so much for watching.